Hey everybody, welcome back to the Perfect Portfolio. And our channel I think is somewhat unique in that we teach a very specific investing and tax strategy known as buy, borrow, die. And it's the strategy that I personally use, and all the students in the Perfect Portfolio use this strategy simply because we don't want to work for the rest of our life. We want to retire early. We want to retire as little taxes as possible, or tax-free in some cases, and we want to pass wealth to our heirs 100% tax free. So we've been building this for a couple of years, and we always have three goals with our students in our course about the Perfect Portfolio, and that is to raise your financial IQ. So, and that's our goal with you guys today, is to raise your financial IQ. We want to teach you to fish, right? So you understand this stuff better. And then obviously, we want a goal to automate your income. There's a saying that says, if you don't make money while you sleep, you can work until you die. And we don't want you guys to work till you die. So you got to make automated passive income. So that's why we focus so much on building income. And I'm just super excited to have our guest here today, which is Troy Cates. And Troy is from NEOS, which is, I would say, a pretty innovative company. I think Troy came out of the womb, and his first word was call option. It wasn't. I don't know if that happened, but but he's a options innovator, and I love innovation. When we were talking before, we were talking about innovation and disruption, and that's my thing. I got to innovate. I got to disrupt, and I'm just super happy to talk to you today, Troy. Just first, tell us about yourself. Like, you were born, and then what happened right after that, maybe a little bit. So. Yeah.
No, well, first, thanks for having me today. I'm really happy to be here. I'll have to ask my parents if my first words were, call option, but I'm not sure if they were.
Yeah.
But yeah, I've been in this business for over 25 years. And prior to that, when I went to college, I was trying to figure out what kind of career path I wanted. And I really kind of focused in on the finance area and focused on studying finance and learning as much as I could. And when I interned towards the end of college, I got an internship on a trading desk in the late 90s. And it was a really exciting thing to me. It was a lot of energy, a lot going on. And to me, that seemed like that's where I needed to be. So I started working after college, and I spent a good 10 years of my career on a trading desk, making markets in equities and options. And it was just a really exciting part of my career and trajectory into Wall Street, basically. And as I started to really figure out where I wanted to be, where I wanted my career path to go, I really started to focus in on more of the asset management space. So my current business partner, Garrett Paolella, and I, we've been working together for well over 15 years. And we had started working together a number of years ago at an institutional sell side desk, where I was on the trading desk and he was more on the sell side, bringing in his clients' orders from hedge funds and mutual funds and so forth. And I would bring them to me and I would trade them. And we both realized like we wanted to kind of get into the asset management side of the business. We had some great ideas on portfolios, and we loved the ETF structure. The ETF structure, it's transparent, it's tax efficient, and it just made a lot of sense to us. And this is, early on, there was no option-based ETFs. There was nothing out there like this. So we had launched a lot of the early option-based ETFs well over a decade ago. We had run that business for a number of years with our partners, and we eventually sold it to a larger asset management firm, and we kind of ran their US ETF business for a couple of years. And we realized they were going on a path of acquisitions, and it really wasn't the path we wanted to go on. So Garrett and I had moved on. We stayed together, continued to work together. We worked at a large hedge fund where we ran a lot of option-based strategies for these pensions and endowments and large institutional clients. And through those years, as working on those, we really wanted to, how can we take all this knowledge and bring it to the mass market? How can we bring it into an ETF structure and really take this institutional thinking and put it in a structure for ETFs that made sense and anybody could buy? Anybody can go onto their online trading account and buy one share if they wanted to, and really have this, call it expertise and this knowledge that we've created and gathered over the past 2+ decades. And so we launched NEOS about 2 years ago. We launched our first 3 ETFs in August of 22, and we just launched another one a couple of months ago. So we've had this really nice trajectory of bringing out this these new ETFs, putting these really nice institutional products. And what we wanted to do is all of our products are option-based products. So if you think of NEOS, it stands for Next Evolution Option Strategies. It's all we focus on. So while you might see a lot of other people coming into the marketplace, there's a ton of new option-based strategies coming out, products with very high incomes. I think as you're thinking about it, look into it. Think about what is this product offering me? So for us, this is not a side business or a bolt-on business to our existing thematic business or something like that. This is all we focus on. So I think if you're looking for institutional managers who focus on options and want to put out tax efficient distributions, we want to get NEOS into your head and thinking about one of the NEOS products that might fit for you.
Cool, cool. Now, options can be used for a lot of things. Options can be used to multiply rate of returns on the upside. Options can be used for income. Options can be used to protect against no loss or reduced loss. I think specifically to SPYI, what's the main goal? Because SPYI is sort of like the initial launch of NEOS, and I know it's doing incredibly well. I think you have like how much it kind of exploded, didn't it?
Yeah, no, we're just over 1.2 billion in assets in SPYI. And it's had a great reception. And, people always ask, how hard is it to launch an ETF? How difficult is it? And we've done it for a number of years, and we've done it as a sub-advisor. We've done it as an advisor where we are now. And it's always difficult to get those initial assets in, but doing it from a startup, a firm that just launched, it's 10 times harder. So in the beginning, it's difficult. You have to rely on different contacts and making those phone calls and getting people interested in the products, talking about our history, how we've been in the space a long time. And then it starts to build upon itself. So yes, SPYI is our largest fund at 1.2 billion under management. But as a firm, we have over 2 billion in assets. So we're really starting to grow from that perspective. But to get to your question, like, what are we doing in SPYI? So this is a product that we're long the S&P 500 names. So all 500 plus names of the S&P 500 in the same weighting as the S&P 500. So we're not trying to do anything differently there. We're not trying to change up what is going on. We like the S&P 500 and what that portfolio looks like. But from an option standpoint, we're employing a covered call strategy. So we're using index options. We use SPX index options. And that's an important thing when you talk about the tax efficiency of the product. We want to make sure for all our products, wherever we can, we try to use index options. Index options get a different tax treatment from the IRS. They're classified as Section 1256 contracts. This gives you a 60% long-term, 40% short-term cap gains rate, no matter the holding period. So if these are held for a day, a month, a year, you still get that 60-40 tax treatment, which is a big advantage inside the portfolio. Remember, ETFs are transparent and they're tax efficient as a wrapper in itself. So all the tax efficiency passes through to the end shareholder. And we want to make sure whatever's in the portfolio is as tax efficient as possible to pass through to the shareholders. So that 60-40 makes a big difference when you're thinking about competitor products out there that might use single name options, might use equity linked notes or different types of swaps to get that exposure. Those are all putting out ordinary income or different kinds of income that's taxed at a higher rate. So the 1256 contract does make a difference. But what are we doing with that? So on a monthly basis, we're rolling these short calls, and we're trying to bring in enough income to give you a 10 to 12% distribution on a yearly basis. We're paying that out monthly. Currently, we're paying just about 1%. So you have that 12% distribution yield, that gross distribution. So we're right at the upper band of where this product can support itself. And, going back to what we were talking earlier, a lot of funds come out and they're putting out these big yields, 50, 60, 70% yield. For us, we want to make sure the product can support that yield. It's not just the income coming in, but what is the total return of the product? So if you think about SPYI last year was up just over 18% total return. That includes the 12% we paid out to shareholders. So you still got that 6% of price appreciation. So it's really important for us to make sure whatever distribution we're putting out, the product itself can support for a long term.
Okay, good. So this is a comparison to when we started the Perfect Portfolio course, we're using just the traditional covered calls traditional cover calls, all that income, if let's say it's a one that's making 12%, that 12% is fully ordinary income tax, the highest form of taxation, right? When you're using, I guess these are Section 1256 options contracts. Maybe what
Yep.
exactly does that mean? Maybe you can simplify that
It's yeah,
somehow.
it's a classification from the IRS that says that these index options, because the index makes up it's not just one stock, it's representing the entire index of, say, the S&P 500 or the Nasdaq 100. These index options get a different tax treatment when you have that holding period. So these are classified as 1256, which gives you that important 60-40 tax split. So when you're looking at it and you're saying, if you're getting a 12% distribution from another product, but they're distributing all ordinary income, whether they're using equity linked notes or a different product to get that income, and that's how they're distributing it. What is your net after tax distribution? So
Right.
when we were building SPYI, it was not only we wanted a tax efficient net after tax distribution for the client to be as close to that gross distribution as possible. We also wanted to make sure it could participate in the appreciation of the S&P 500, which is really important for us. So part of how our option strategy works and what our rules-based strategy does is it doesn't necessarily need to overlay on 100% of the notional of the portfolio. And that can change month to month. There's a number of factors that go into that, whether it's where volatility is, the rate exchange of volatility, but there's a number of things that could go into that to say, okay, this month, this roll period, for SPYI, for example, it's only going to be 81% covered, leaving 19% of the portfolio not covered by short calls, and not only helps you on the upside appreciation, but it helps the overall total return of the portfolio. So the option portfolio, we're always selling calls out of the money. So we, on average, to give you an idea, since we launched the product, we're anywhere from 1% to 4% out of the money on the laddered short calls.
Okay.
And then we're not writing on 100% of the notional, depending on where volatility is, to get that upside appreciation in the portfolio as well.
Okay, so the primary goal is we want it. Your first shooting is 12% dividend, right? So about 1% per month.
Mhm.
It could be a little more or less. And then you want appreciation as secondary. So there's a portion of the upside of the S&P 500. And then the third is tax efficiency. So you want to make sure that somebody's in a high tax bracket, they're getting long-term capital gains taxes regular than income tax. That pretty much wrap it up with it.
Yes. Now
Yeah.
that's how it is. Yep.
Yeah, and when you're building the portfolio, I see there's options too. You're selling the option to collect the revenue, but then you're also buying an option at some point in the future. Has that happened yet in the portfolio? And why did you add? Sometimes we can buy a call option on the S&P 500. How does that work?
Sure. So the way our model works, the way our rules-based strategy works, is in periods of very low volatility, the model can switch, and this could be done on a monthly basis as we're rolling from one month to the next. It can switch from being a laddered short call portfolio where we're short, say 2 different calls out of the money,
Okay.
to a call spread where it's selling a call closer to the money to bring in that income. But given that volatility would be low, the portfolio would buy a call a little further out of the money. So to give you an example, let's say we sold a call that's 1% out of the money, and we use some of that premium to buy a 4 or 5% out of the money call and have a cheap upside call with still enough income to pay the distribution. But on those months where maybe the market does kick higher, we're not going to miss that complete upside. Has it done it since we've been live? No. It's
Okay.
come close when volatility was lower last year, but it didn't get to the point where we switched to that call spread portfolio. So since it's been live, it has only been in the short laddered call portfolio.
Okay, and that's the purpose of the laddering. How does laddering? Why do laddering of options, selling them rather than just do a traditional covered call? Just sells one option, one strike price. Why is laddering better than just selling one
Sure,
call
it's
option?
just if you think about spreading out the risk, we're bringing in enough
Okay.
income. If we're selling, say, 2 different calls, and one is maybe 1.5% out of the money, and the next one's maybe 3 or 3.5% out of the money, we have that room for the market to move up. So if you think about it, if we sold a call 1.5% out of the money on 40% of the portfolio, and 3% out of money on the other 40%, we left 20% of the portfolio uncovered to appreciate even higher if the market did move through those levels. We're not capping the portfolio saying, hey, this is a line in the sand at 1% or 1.5%, that we want to be able to participate. So laddering the calls out in our model made sense for us. And that's that's why we do it.
Okay, now let me see. I love tax avoidance. I mean, my second book is called Top 10 Ways to Avoid Taxes. So we talk about long-term capital gains. We talk about tax loss harvesting. How does tax loss harvesting work in this point? Because what would be an example where you would use that?
Sure. So if you think about the ETF structure and we talk about how tax efficient it is, if you have losses generated in the ETF, in the actual fund, those losses can be carried forward indefinitely. So let's say you have a portfolio of stocks in the S&P 500, and those stocks, for the most part, you're not trying to sell or rebalance those stocks too often, unless, let's say, the S&P 500 does a rebalance and they drop a name or add a name. Those are times you have to actually make sure we're keeping up with where the index is from an overall constituent standpoint. But if you have an overall equity portfolio that is not touched too often, you have this, market that's moving higher, you have this upside appreciation, but then you have this option portfolio that is having these, 60-40 long-term, short-term cap gain splits. And on a monthly basis, you're rolling that. On a monthly basis, there's going to be a P&L to it. Some months you're going to have some losses in those options. Some months you'll have some gains, but those gains and losses will pair off against each other. But if there's a market moving higher, inherently in a short call portfolio, you're going to lose money over time in that actual P&L of that portfolio. It'll bring enough income in to make those distributions. But if that P&L gets to be a point where those losses are being distributed, that might be considered through that tax loss harvesting, might be considered a return of capital. And so if you think about how that return of capital, a lot of people kind of get scared and want to back off and say, wait, return of capital, am I just getting my money back? And we're not looking to return your principal. We're looking to see how we could use the tax designation of return of capital in your distributions, or at least a portion of it, to make sure you're deferring those taxes further out. And if, for your scenario where you guys are never selling it, maybe it's never coming to fruition. But for someone that might sell the product 2 years down the road, it might be a long-term capital gain. As their basis moves lower, they might have a long-term capital gain versus paying an ordinary income in the same year. So if we can get any part of the distribution classified as return of capital at the end of the year, that's really important for how these option portfolios work.
Okay, well, yeah, because return of capital, if you watch a lot of, even videos on this, return of capital, people go, oh, well, I don't want it. You're just taking my money and then sending it back to me, which is not the case. You guys are actually getting the 12% dividend. If it was a 5% appreciation, you guys may be able to give them a portion of it, return of capital, so it's not tax-free, but it's not eroding your residual principal, correct?
Yeah.
You're actually taking it from the appreciation. You're just doing it in a tax efficient way. Would that be a good?
Yeah. So to give you a real example,
Yeah.
if you look at last year, in 23, SPYI was up 18%. We distributed in the fund 12% went out to shareholders. So it had that
Yeah.
6% of price appreciation. But if you looked at a 1099, I believe just around 60 or 65% of that was considered return of capital, even though you had a NAV that was moving higher. Price appreciation covered the distribution. 65% of that was considered return of capital, and the rest was a mix of QDI, qualified dividend income, which gets a lower tax treatment, along with that 60-40 tax treatment from the index option. So you had this really tax efficient 12% distribution last year, while still having the overall NAV of the product moving higher.
Lots of tax advantages, and of course we're never going to sell, so that sounds like a very good fit for the perfect portfolio. And the fact is, I own SPYI. I also own QQQI. So let's jump into QQQI. I personally look at the S&P 500 and say, look, a lot of the gains come from technology stocks. When did you launch QQQI, and when did that idea come up? And
Sure. So, I mean, we had the idea to launch QQQI when we launched the initial suite of funds in August of 22. It just takes time to get these products out. There needs to be approvals. You have to license the name, the NASDAQ 100. You have to license the index, just like we did with the S&P 500, to be able to have that in our name and be able to license and use the index and track the index from an equity standpoint. So we really wanted to get QQQI out as a follow-on to SPYI, because if you look at an overall portfolio and you think about a pie chart, we have SPYI was that kind of core equity portion of the portfolio. Our fund CSHI, which is our enhanced income 1 to 3 month T-bill ETF, was that more ultra short duration or cash portfolio. Then you had BNDI, which is our enhanced income aggregate bond ETF, which kind of slotted into the fixed income portion. But now as we're expanding more, we want to divide up that equity portion. So QQQI, being the NASDAQ 100 high income ETF, we really have a very similar strategy to SPYI, still using index options. We use NDX index options, so it's a NASDAQ 100 index option. And we're using the overall NASDAQ 100 portfolio, so we're long all 100 plus names of the NASDAQ 100 in the same weighting and rebalancing when they rebalance, add, delete when they add, delete, different names. But it's the same type of structure. But the NASDAQ 100 inherently has more volatility than the S&P 500, usually 20 to 25% more volatility in the NASDAQ 100 because of the name, the growth names, and the technology names that are in there. So with that added volatility, you could bring in more option income. Right. So this one, it kind of aims a little higher. We want to have a 12 to 15% distribution is kind of the range. Right now, we're distributing over 14% of tax efficient income from QQQI. So it's a really nice product. Very similar. Again, we're selling calls out of the money. We're not overlaying on the entire portfolio. So where volatility of the NASDAQ 100, you think of the VIX as volatility of the S&P 500. For the NASDAQ 100, it's the VXN. If anybody wants to look at it, that's the volatility of the NASDAQ 100. So to give you a live example, right now, the portfolio is about 70% covered. So 70% of the portfolio is covered by 2 out of the money calls when we had rolled those at the end of April. We'll roll the next ones at the end of this month. And that 30% of the portfolio that's not covered has room to move higher and appreciate higher. But we brought in enough income from that roll to be able to roll on only 70% of the portfolio.
Cool, cool. That's awesome. So basically, to summarize, it's going to be a little more volatile. So if the S&P, let's say SPYI went down 10, is QQQI going to be down 12, or is the options premium going to make? Do we have enough history on that?
So if you think about it, when do these products are not hedged,
right?
But you will outperform in the flat to down months by the amount of premium we bring in. So if you have a month where the S&P 500 is down, say 5%, rough month in the S&P 500, what would SPYI do in that scenario? It might be down, if we brought in 1 to 1.5% in income that month, we might be down 3.5 to 4% versus the S&P 500 down 5. So it's not so much, you get that little bit of buffer on the downside from the option premium brought in. But the idea is when we have those months where we bounce back, it could participate in a lot of that upside and really get that NAV back into the fund.
Okay, so up markets, we're not going to beat the index. SPY is not in a big soaring bull market. We're not going to beat S&P 500, but those flat markets, S&P runs flat for 6 to 12 months. Are we going to beat the S? And then, of course, in the down markets, we obviously are, because we're not going to get the full participation because of the income is going in there, and we're not fully in the market. Does that sound about right?
Yes, if we had these rip-roaring months, you think about November of last year, the S&P 500 was up 9.5% or something like that. SPYI was only up 4.5% because we can't capture that entire upside in a very fast up move like that. But yes, if it was up 9% over the entire year, divided equally, and it's grinding higher, we should be able to capture a lot of that upside with writing calls out of the money and still being able to distribute the real tax efficient income, but not so much hitting those short calls or blowing through those short call strikes.
Okay, good. So, well, that's awesome. I think we pretty much have an idea what this is. It's get your 12%. If we can get some market appreciation on that. And of course, we want as many tax advantages, tax loss harvesting, return of capital, all those things that I love that are just magic to me, because I just don't like taxes personally. So I think, but anyways, I know that one thing we have in common, I think we both like extra income. We both like less taxes. We both like to innovate, and we both disrupt. So what's next for NEOS in the horizon? Anything innovative, disruptive, tax efficient coming, or I know you can probably only say so much.
So yes, innovating is something that we like to do. We want to make sure we're ahead of the curve and trying to get new products out there. But we're not just trying to get as many products out there as we can. We want to thoughtfully bring out products that we could support, that we think there's a need for in the market, and there's, you know, a place for it in someone's portfolio. So we have a couple in registration right now. One on using a Russell 2000 to kind of broaden out that equity basket. So we'll have the S&P 500, the NASDAQ 100, a Russell 2000 product out. That'll probably come out this summer. It's in registration right now. And we have some other funds and ideas that we're going to do. We have some acquisitions that we're working through right now with some proxies. So all exciting stuff. And we're hoping to continue to grow the suite and, you know, thoughtfully bring out products that are institutional quality, that make sense, that are tax efficient, and that people can use in their portfolios for years.
Yeah, and I know you also use like a little bit of spread trades within your contracts. I mean, I know there's options. I think you have one in the works, or which came back where it was really a covered call with a protective put, and that's coming back on the market. Can you comment on that at all?
Sure. So yeah, we've had products where we were doing net credit collars, and we're looking, you know, we have one in registration that's a proxy of another fund that we're going to be bringing out, which is going to be more like a hedged equity product, where we have more like a put spread collar, where we have a put spread and then a short call on top. And we have some products right now that have put spreads in them, you know, CSHI and BNDI. Those are more on the fixed income or cash alternative side, where we are selling SPX index put spreads to bring income into the portfolio. So if you think about CSHI in a low vol equity, you know, low vol option portfolio, how can you bring in an additional 1 to 1.5% over whatever your T-bill portfolio is doing? And that's where you get CSHI selling those SPX index put spreads. We roll those a little differently. Those are rolled on a weekly basis versus some of the monthly rolls we do on the equity side. So it's, like I said, we're trying to get out good, thoughtful, institutional type products that can fit into, you know, most portfolio allocations.
Awesome, awesome. So, well, I'm just really grateful of a couple of things. As one, I'm grateful for you options guys, because I used to be an options trader for 20 years ago, and the complicated stuff that you guys do. I'm so happy you get that there was innovation to creation of ETFs, because it's great. You can take 8 or 9 different ETFs that are essentially complex options trade, put them into portfolio, and you can have a pretty cool portfolio. You're going to sort of build your own you know, little fund yourself by using all of these different types of ETFs. So thanks for being on with us today. Thanks for disrupting, and thanks for doing what you do, because I love to see competition in the marketplace. Competition makes us all better, right? It's not, and we can get better products, and hopefully we can retire some people early. So thanks again for your time. And to all our listeners or to our followers today, if you guys are interested in the perfect portfolio, specifically to learn the buy, borrow, die tax strategy, we do that strategy on not just stocks and ETFs. We do it on life insurance, real estate, cryptocurrency, and even gold and precious metals. And of course, all those assets have one thing in common, is that you can never sell them. You can borrow from those assets to fund other assets. And when you die, you get a step up in basis, another tax tip, step up in basis, and you can pass all that wealth to your heirs, and then you can teach it to your kids. So if you're interested in that, our next overview for the perfect portfolio is June 5th. That is 6 o'clock PST. So 9 o'clock Eastern time on Zoom. And if you wanted to just come check out the perfect portfolio, we obviously use the most innovative strategies in the market, and you can learn the strategies. Just go to theperfectportfolio.com, and you can send us a message there, and we can invite you back to the course. So again, thanks for your time, Troy. We appreciate you guys. And thank you to everybody watching our channel. And we hoped we raised your financial IQ today, guys. All right, guys. Thanks.